you all very much for coming. It's lovely to see so many people here. This is a lecture that I have heard many times before because, as many of you will know, I came here from Oxford. I've only just arrived here, and Chris has been doing this lecture for us in the corporate finance course I taught on in Oxford for many years. But it isn't just for people doing the corporate finance course. I think anyone who's interested in the way that finance works and the financial markets will find it interesting. What Chris does is not only tell us how private equity works, he's going to tell us what's happening in the markets, and there will be his own views on the way that the markets are developing at the moment. And certainly, he first started doing it in Oxford, I think it might have been the year after the financial crisis, around there. Yes, yeah. So we had this kind of amazing year-by-year view of how things were developing. And first of all, it was terrible, and then it was getting better. And, there was this kind of wonderful overview we have of the way the market works. For those of you, if there are any of you who don't know who Chris is, Chris Hale is from Travers Smith. He used to be a senior partner, and before that he was head of corporate, and he's now chair emeritus.
Yeah, I know.
Wonderful title.
Yeah, you recognise that in the academic world.
And he's worked basically in private equity for many, many years, right from pretty much the beginning, I think.
Yeah, we had since before the term was invented. Actually.
Yes. So he can give you a very good overview of the way it has all developed, and he has very much, if you go on his website, I won't read it all out, but he's been voted, in the absolute top-notch private equity lawyer by pretty much every the ranking systems that there are. So he's absolutely the right person to come and talk to us about that. Actually, what I didn't ask you was, do you want questions at the end?
No, I quite like questions as we go along, because you're going to get a bit bored if I drone on for 2 hours. And if you've got something you'd like to ask, do raise your hand. I mean, if it's going to take us completely off course, then I'll probably shut you up. But if not, it would be helpful to have a bit of a discussion as we go along.
Okay. Well, that's.
And I will ask you 1 or 2 questions as well. That'll keep you awake.
Okay, so the idea is to finish around 6. There will be obviously time for a bit of discussion at the end, I hope, as well. And thanks to 3CL and the sponsorship, which I think is Travers Smith.
It is, yes,
actually,
yes.
There will be drinks afterwards, and then you can get to talk to Chris as well at that stage. So, thank you very much, Chris.
Thanks, Louise. So what I'm going to do today is to, from a practitioner point of view, provide you with a fairly broad backcloth to what private equity is and how it works. So I'm going to talk, to begin with, a bit about the term private equity, look at whether it's a worldwide phenomenon or rather more concentrated, how important it is economically and for those who practice in M&A, how successful it's been and touch on why it might have been successful. And then get into some of the nuts and bolts. How does it work? How does it work at the fund level? How does it work at the deal level? And in relation to the deal level, I will focus on what lawyers do. Most of you will have an interest, I hope, in the future as potential practicing lawyers. And this will give you a flavour for what you would be doing if you entered the private equity space. And then I'll conclude with a few final thoughts. The trouble with the term private equity is that there's no accepted definition of what it means. And it's used rather loosely and not in the same way by a lot of those, both in the industry and those who comment on it. So it is used as a generic term, sometimes to cover just buyouts, sometimes to cover venture capital, growth capital and buyouts, and sometimes to cover venture capital, growth capital, buyouts, and other strategies such as real estate and infrastructure. I'm going to quote quite a lot of statistics to you, and those statistics really relate to the combination of venture capital, growth capital, and buyouts. And the vast bulk of what I'm going to talk about is really focused on buyouts when we get away from the statistical element. That is by far the biggest component of whatever you mean by private equity. But what are its key characteristics? Well, I've put them up on the slide. These are drawn from publications of the British Venture Capital and Private Equity Association. You can pick up from the name the confusion even within the industry. So it's risk capital provided in a wide variety of situations, ranging from finance provided to business startups, to the purchase of large, mature, quoted companies and everything in between. And its key elements I've put up: investment in unquoted companies, equity capital by nature, and we'll explore later what that means, medium to long term, and I'll provide some context and definition around that, and targeted at companies with growth potential. Now, before I get on to the geography of private equity, I'm just going to give you a very cursory history of private equity. I like history, actually. I studied here for 5 years, and the first 3 were doing history. Venture capital started in the US and the UK after the Second World War. In the UK, the major banks set up something called ICFC that later became 3i, if you've heard of 3i. In the US, there were a couple of private companies that were set up to do something similar, which was to provide capital to new young companies. The buyout part of private equity developed in the very late 1970s in the US. Krollberg, Kravis and Roberts, now KKR, one of the largest private equity houses, in those days worked for Bear Stearns, one of the investment banks that floundered in the great financial crisis in spring 2008. And while they were there, they started doing what we would today call buyouts. They left Bear Stearns in the very late 70s and established their own firm, KKR, still going, very successful. And it was through the 80s that buyouts began to develop in the US in something approaching the form we understand buyouts to be today. The UK followed fairly soon afterwards. I started practicing M&A and venture capital in the early 1980s. I was a child protege, as you could probably guess. And the buyout bit appeared on the scene in the later 1980s in the UK. Now, bring us right up to date with this slide. This shows over 3 years, the last one being 2017. You may not be able to see it very easily on the slide. The first one is 2015, the second one is 2016, and the third one is 2017. And the blue bar is the amount of money that was invested in each of those 3 years in North America, mostly in the US, some in Canada. The bar above it, the darker one, the darkest one, is Europe, and that shows the amount of money in each of those years that was invested in Europe. Grey is Asia, and red is the rest of the world, Latin America, Africa, Australasia. And as you can see, even today, around half of private equity money is spent in North America, and the bulk of the rest is spent in Europe. And within Europe, in most years, in the last 10, around 40% of the money has been spent in the UK. Now, that figure has been lower in the last 2 years because of the uncertainty that's been created as a result of the Brexit saga that's unfolded like an unpleasant car crash in this country over the last 3 or 4 years. But in most years, it's about 40%. And London is the base from which private equity fund managers in Europe tend to work and invest not just in this country, but elsewhere in Europe. So London is actually the most important portal in the world for private equity. And one question mark for the future is, will London maintain that position in the new post-Brexit world? And one area I want to look at, no, I'm not going to do it today, but in the future, when I examine aspects of private equity, as I'm hoping to do, is to look at whether there's a particular ecosystem and the characteristics that really are needed for private equity to prosper. One of the more prominent private equity houses, Apax, published a report some years ago called Unlocking Global Volume, Future Trends in Private Equity Investment Worldwide. And they attempted to rank 33 countries by how congenial they thought they were to private equity based on 5 criteria, a couple of which were things like the rule of law and legal system and openness of financial markets. And perhaps not surprisingly, the top 2 countries were the ones that I've been talking about as being the real foundation for the industry, namely the UK and the US. And the bottom 2 were, I don't know whether you would guess what the bottom 2 were. Anybody want to have a guess? India and China. And about 20 years ago, at the beginning of this century, there was a lot of hope as the private equity world was maturing in the US and the UK, that private equity would really grow very rapidly in Asia. After all, Asia is where you find most of the people in the world. The economies have been booming, but no, it hasn't taken hold as quickly as everybody then expected. And I suspect it's because of this ecosystem issue that I would like to look at in more detail. So how important is private equity economically? I'm going to focus this part of what I say on the US and the UK, and to some extent the rest of Europe in particular, just to give you an idea of where it features in the firmament economically in those countries. So according to Bain, in 2013, private equity-backed companies accounted for 23% of America's mid-sized companies and 11% of its large companies. Now, I don't know how they define mid-size and large, but it gives you a flavour. And I've taken this from an article Brian Cheffins has written. 4 of the top 10 employers in the US, if you take together the employees in each of the investee companies in the US of private equity houses, 4 of the top 10 employers in the US are private equity houses, and they are probably the ones you would expect if you know anything about the industry. So Apollo, KKR, Blackstone, and Carlyle. So it's very significant in the US. In the UK, it is also significant. There used to be research published each year looking at how important private equity was on a number of criteria, one of which was employment. Regrettably, this research last appeared in 2008, but then those who did it was an independent consulting group called IEC, said that around 3 million people in the UK, equivalent to 21% of the then UK private sector workforce, worked for companies that either were or had been backed by private equity. And if you look on that slide, there's a range of UK-based companies that fit those 2 criteria, were or are today backed by private equity. I put on the slide names that you might recognise: Formula One, Pets at Home, Boots, the chemist, Pret-a-Manger, where you buy your sandwiches. They actually have all ceased to be private equity backed quite recently. Ones that still are on the right side of the slide. The one at the bottom, Merlin Entertainments, has been backed by private equity, went public, and has just been taken private again by some private equity houses. And that journey, that cycle, is quite a common one. The wider effects on economic life of private equity has been the subject of a lot of debate, and in particular, the effect private equity ownership has on employment within the companies that private equity backs. And the picture isn't a terribly clear one. Most of the research I read indicates that private equity encourages growth of employment in the companies they invest in, and that growth is faster than in UK listed companies. But there is research showing something slightly different. The best article that I've read on the subject was one that was published very recently. It's a Harvard Business School paper published in October last year, called The Economic Effects of Private Equity Buyouts. And it's by a range of US academics. Somebody called Josh Lerner, who's a particularly assiduous writer about private equity, was one of them. They examined thousands of United States private equity buyouts from 1980 to 2013, looking amongst other things at the effect of buyouts on labour productivity, compensation per worker, and employment. And their conclusion isn't one that surprised me. And I'll just read it to you. It says, in short, the impact of private equity is more complex and varied than champions or detractors claim. Proponents such as Jensen, it's his article on the reading list, Louise.
Well, I haven't really put much on the reading list for
Okay.
But yeah.
He wrote quite a famous article on private equity in the late 1980s, 1989, called The Eclipse of the Public Corporation. He's a big advocate of private equity. Proponents such as Jensen see buyouts as engines of efficiency and value creation, fueled by the concentrated ownership of target firms, highly levered capital structure, and high-powered financial incentives. Critics see these same features as harmful to targets and their workers and a source of systemic risk. And I might ask you about systemic risk a little bit later on. We find strong support for the engines of growth, engines of efficiency view in the most prevalent deal types. So they're saying Jensen's view is probably right. With respect to employment and wage effects of buyouts, our evidence is mixed and contingent on deal type. The post-buyout performance of target firms also varies with external credit and macroeconomic conditions. It's a long article, that actually, but if you've got time, it's worth a read. And there's a little bit more data on that slide, and I think the slides are going to be available if you want to look at them in more detail later. Within the US and Europe, private equity is very, very important to those like me working in the M&A world. The fees that are paid in relation to private equity deals worldwide account for about a fifth of the global banking system's revenues from mergers and acquisitions. In the UK and the US and other Western European countries where private equity has really taken hold, like France, and today increasingly Germany. There's a lot of resistance in Germany to private equity, but that's now beginning to disappear. They will account for a much higher percentage. There's a body that collects statistics in the UK about buyouts called the Centre for Management Buyout Research. It's now based at Imperial College. And they say that buyouts accounted for 30% by number of deals and 64% by value of deals in the UK in the first 9 months of 2019. Now that value figure, 64%, is not untypical in the last 10 years or so. The number of deals percentage is actually lower than it has been in most of the last 10 years. Usually it's around about 50%, and the Brexit overhang is, I think, part of the explanation for that lower figure. And just to give you an idea of how important globally to M&A private equity is, in many of the last 10 years or so, private equity, this is private equity, the CMBOR figures are buyouts, not venture capital and growth capital as well, but the global figures for private equity are that it is accounted for approximately 15% of global M&A value and something in excess of 10% of the number of deals. So very, very important to those in the M&A world, and in particular those in Europe and the US. Now I've got something to hand out to you. I've got a few copies here. Louise hasn't seen this, so... every year, another statistical compiler called Preqin publish a report, Preqin Global Private Equity and Venture Capital Report, and this is the one that came out a few days ago. There's a huge amount of data on private equity and how it's doing. What I've just handed out is actually taken from the 2019 report, because the equivalent graph in the 2021 it isn't as clear. And as you can see, you won't be able to read it on the screen, but you will be able to from the handout. And what that shows is the growth of assets that private equity houses, and I'll come on to describe what a private equity house is, manage, and how they have developed since December 2000. And you'll see that over the 17 and a half years, they have grown from 577 billion, these numbers are denominated in billions, and this is dollars, to, in June 2018, $3.4 trillion. Now, actually, as of today, according to the report they published a few days ago, that number's grown to $4.11 trillion. Some of it is invested in companies that are under private equity management at the moment, and some of it is a waiting investment. And the element that's a waiting investment is called dry powder. That's the dark bit at the bottom of the chart. And as of today, according to Preqin, there is about $1.5 trillion of dry powder awaiting to be invested. Now, you might think that that's going to be a problem with how they're going to invest that quantity of money. And won't it force prices up, meaning returns are low? That's possible, but interestingly, Bain Capital, and I'll refer to their report again, who also publish an analysis of private equity. Their report came out on Monday. They've analysed the age of current dry powder, and they say that actually it's not been getting older, even though the amount has been increasing. So that seems to indicate the rate of spend is keeping up with the funds that are being raised. Now, how does private equity... Yeah, sorry.
Sorry, so John, before moving on, why has there been such significant growth? What are the factors that have led to that?
Well, that's exactly what I'm going to come on to. Why has private equity been successful? Well, how does it make its money? Private equity makes its money, so it is said, from three main ways. It was said that in the 1980s, the money was made by leverage, that is debt. Now, on a private equity deal, we'll go into this in a bit more detail, the amount of debt that is used as the combination of money to buy another company in a buyout is probably today around 50 or 60%. It's sometimes said that private equity-backed companies have capital that is 70% debt and 30% equity, and public companies are the other way around. And it is true that there is a good deal more leverage in private equity-backed companies than in public companies. Now, a question for you, why do you think there is less debt in public companies? Anybody want to have a guess? Well, yes.
They raise capital through the equity market, so they would get equity financing rather than debt.
Yes, that might be a reason. But there's one character, sorry.
Very steady dividends.
Correct, exactly. Yes, public companies usually pay regular dividends, and some of them are actually very substantial, whereas private equity firms don't. And to enable those dividends to be paid, it wouldn't be possible to be levered to the same extent as private equity companies are. I think there is probably a cultural issue, and the ownership model is obviously different. And is it right that a dispersed ownership structure of the sort that you see in the public markets is suitable for what is seen as a more risky capital structure with a lot more debt in it? Anyway, that's what you see. So leverage, and I'll explain how that works in a lot more detail later. It was said that in the 1990s, private equity made money by multiple arbitrage. Now, what that means is that you buy a company at £100, nothing changes in it at all, but the price of that company has gone up to £150 simply because demand for that type of company has increased, meaning the pricing for it goes up. And the multiple means the multiple of the EBITDA of the company, earnings before interest, tax, depreciation and amortization, multiplied by a number, and that's the multiple. And multiples go up in times of high demand for particular assets. So you might buy a company at a 10 times multiple, 10 times EBITDA, and during your ownership, the demand for that asset might increase, and you can sell it for 12 or 13 times that EBITDA. And even if you've done nothing at all to that company, then you've made a very good profit. And it was said that in the current era, what you had to do was increase profits by working with companies to improve them operationally. In fact, in most deals, all three are in play to some extent. And the extent will vary from company to company and the particular characteristics of the investment. But to answer your question, why has the assets under management grown like this? Well, that comes down in part to returns. Private equity says that it produces better returns for those that put money to work with it than an investment in the public markets. And there's been a lot of academic research on that very subject. It's very difficult to actually get an accurate answer because you're not comparing apples with apples, and there are a number of academics who've tried to produce public market equivalent measures for private equity to ensure they are comparing apples with apples. But even then, there are a lot of assumptions that go into the analysis. It's also the case that private equity is private, and data sets aren't readily available in the same way as they are with public listed stocks. So actually getting hold of the underlying information is not all that easy. Some more have become available. The sort of Burgess data set is a particularly extensive set, and some academics have got their teeth into that. And the majority of the research, by some way actually, does show that private equity outperforms investments in the S&P 500, the FTSE 100 and other main markets. Now, there was an article that appeared in this Monday's, I think it was 24th of Monday, FT, that says private equity outpaced over decade by roaring stocks. Well, that article is actually extremely misleading. It's based on some research that Bain and some academics, I think Josh Lerner, who I referred to a few minutes ago, was one of them, undertook recently, and it's in the Bain report that came out on Monday, which is why it appeared in the FT then. And if you read that, what the research shows is that in almost all geographies, over any period of time you choose to take, according to them, those academics and Bain, private equity has outperformed public markets. Now, in the last 10 years, in relation to the S&P 500 only, so not in Europe and by reference to European indices, the S&P 500 did outperform private equity, but the difference was 0.2% over that decade. So hardly a big number. And they say that the circumstances in which the S&P 500 did that were highly unusual and unlikely to be replicated. So the answer to your question is that returns and return expectations of investors must be one of the main drivers behind so much money flowing into private equity. And that's supported by the studies that Preqin do, the statistical compiler I was referring to. They, every quarter, ask investors, are you happy with the returns you get from private equity? Do they meet your expectations? Do they exceed them? Or do they fall short of them? And pretty much every time, 90% of investors, and they survey a very, very broad range, say we are happy or they exceed our expectations. So to some extent, the proof is in the pudding. Another answer to your question is, you'll see who the investors are, is that the returns that appear to be generated by private equity are in double digits, 15% plus. And in a low yield world, there aren't too many investments where you can get that sort of return. One of the issues for investors, because there is quite a lot of variation in performance between one fund and another, is choosing the one that is going to be a top performer. And there is a particular trend that I will come on to later, which sort of illustrates that point. So why has private equity been particularly successful in this sort of way in delivering those sort of returns? Well, Bain highlights in their report some reasons why the top managers do especially well by comparison with other managers and with public market investors. And what they say is focused firms win and win consistently because commitment to a formula sharpens all phases of the value creation cycle. They source deals better than others based on a keen understanding of what they're looking for and where to find it. They assess value more precisely in diligence because they are confident in their ability to identify opportunities and manage risk. During ownership, they know what works and what doesn't, and they have a clear, active strategy for capturing value. They're more adept at developing the right management team, adding capabilities when necessary, and tapping into the right ecosystem of partners when that makes sense. So that's Bain's take on the top-performing managers. I think more generally, there is another issue at play, and that is the fact that the governance structure in private equity compared with the public markets. And I'm going to come on to, in a second, to the way the public markets have been performing in the last 20 or 30 years. So the governance structure in private equity involves a private equity house putting on the board of that company some of the executives who did the deal. They will meet with the senior executives probably once a month. They'll be heavily involved in determining the strategy and key decisions relating to the underlying target company. And they will be aligned with the senior executives because the senior executives will have shares alongside the private equity house. And they'll all be working to a common objective of realizing value for those shares over a particular period. That aligned model isn't one you see in the same way in the public markets, where public companies have thousands and thousands of investors, each with different investment objectives. And there isn't the same active monitoring by private equity, by public company investors of what's going on in the underlying target. And some would argue, Jensen, for example, the discipline imposed by debt as part of this governance structure focuses a company on operations and operational efficiency. But most of the evidence shows that it's this management equity stake that is one of the key differentiators in the success of private equity compared with the public markets. The dangers of the listed company model is demonstrated by the scandals that erupted a few years ago, which you'll probably be familiar with: Enron, WorldCom, Hollinger, Parmalat. They're the inner circle of professional managers running a widely held company, held only a small percentage of the equity, a tiny fraction. And those in charge of those companies were tempted and did use their control over corporate assets, relatively unsupervised, to further their own interests at the expense of those who actually owned the equity. That wouldn't happen in private equity. All of this was summarized quite well in a lecture Paul Miners, who was the chief executive of a big asset manager in the UK, Gartmore, for a period, minister for the city in the last Labour government, and it has been since the last Labour government a professional non-executive chairman of both private and public companies. And he said in this lecture here, overly diversified public company portfolios, that's by public company investors, with a significant number of underweight holdings, means there is little economic incentive for the fund manager, individually or organisationally, to adopt the mindset of an owner and behave accordingly. If there is any sense of ownership, it applies to a portfolio as a whole and how individual securities interact to affect risk relative to benchmark. There is little focus on ownership responsibility towards individual companies. We thus have a critical vacuum in governance. No one actually takes on the responsibility of ownership. For the past year, I've been chairing an unlisted company financed by private equity. I've been struck to the extent by which this ownership model leads to strong and effective governance, focused on the aligned interests of owners and management. All are working to a common agenda, with shareholders fully engaged on strategic issues and in receipt of timely and complete management information going well beyond financial reporting. Contrast this with the situation for a public limited company, where shareholder engagement on strategy is almost non-existent, reactive at best, and reporting is formulaic and limited in its interactivity. So, private equity has been booming. Lots and lots of money has been pouring into it. So, what's been happening in the public company world while all this has been going on? Well, the public company world has not been doing all that well. The universe of listed companies in the UK and the US has been shrinking. Since 1996, which was the peak, the number of US listed companies has diminished by half. It's today about 4,000. In 1996, it was about 8,000. In the UK and Europe, there's been a shrinkage. It's been slightly less dramatic. According to some research I saw, between 96 and 2017, the number of companies on the main market of the London Stock Exchange shrank by 57%. So it's a big number. Why is that? There are a combination of reasons. There have been far fewer IPOs. Last year was a particularly poor year. I think the poorest year for a long, long time. But the paucity of IPOs wasn't a feature just of last year. It's been a feature of the last 10, 15 years. Public companies have been taking each other over. Some have been delisting. Some have turned to debt rather than equity in a low interest rate environment to finance what they want to do rather than issuing more shares. And there's been massive share buyback programs that have shrunk the stock of public company shares available for people to buy. But all commentators agree that one of the key reasons why the public markets have been shrinking in terms of the number of companies on them is the growth of private equity. You've seen the amount of money that's under management. Well, what has accompanied that has been the growth of bigger and bigger funds recently. So in the lead up to the great financial crisis, big funds were $10 billion or so. And then at the time of the financial crisis, fundraising became more difficult and fund sizes shrank. But in the last 7 or 8 years, big funds have reappeared. The biggest fund ever raised until recently was raised by Apollo, which was $24.6 billion. And that was exceeded, I think last year or the year before, by Blackstone's latest fund, 25 point something billion dollars. And there are now quite a lot of $10 billion funds around. And just as before the financial crisis, deal sizes were getting bigger and bigger as bigger and bigger funds were raised. So we had Boots up on the slide earlier. That was the only so far take private of a FTSE 100 company, and that occurred in 2007. More recently, we've had some very big buyouts in both the US and the UK, well into, in the US, double-digit billions. In the UK, it took a little bit longer to get back to the really big deals, but last year there was a raft of public to privates that were substantial and in some cases controversial, like the £4 billion take private of Cobham, which has a substantial defence business, and that led to controversy. It was taken private by an American private equity house, Advent International, and rather misunderstanding the way private equity works, some commentators saw this as a threat to the UK security industry because a US, they thought, investor was taking it over. Merlin was actually the biggest private equity deal in the UK last year, which was up on my slide, been in private equity hands, went onto the market and taken private only in the last few weeks in a £4.8 billion deal. Now, Brian Cheffins, who you probably know, is a great advocate of the public company. And he will point out that while what I'm saying is true, if you look at the relative valuations of the remaining public companies by reference to, say, GDP, the S&P 500 market cap of the companies in it by comparison with the US GDP, for example, the US public markets haven't been declining. And the same analysis may well be true in the UK. And he is right. But the trend has been for more and more companies not to come to the market and for those remaining on it to become bigger and bigger. Some of them are now absolutely ginormous, like Apple and Microsoft and Google. Apple, until 4 days ago, had a market capitalization of $1.5 trillion. I mean, I've got an Apple Watch, actually, and I have on the front of it how the FTSE 100 is doing, and it's going down dramatically fast. And so Apple's market capitalization will be today less than the 1.5 trillion it was on Monday. It might be 1.2 or 1.3, but even then, Apple alone is bigger than almost every country's GDP. It's remarkable. However, while companies on the market are getting bigger and that GDP type of measure remains, the number overall is shrinking, and the old purpose of going onto the market, which was to provide a route for private shareholders to realise their investment and to raise money to enable the company to grow and develop, is to some extent being replaced by private equity. They provide the exit, they provide the capital. So companies don't need to list in quite the same way as they used to. And there's another factor at play, and that is that a lot of senior executives don't want to go onto the public markets and be directors of public companies. Now, why is that? That is because the disclosure burden on them is becoming greater and greater and greater. And you could argue that many CEOs of public companies, because of that and the scrutiny which their actions are put, are becoming, and their companies are being put, are becoming sort of glorified PR agents, rather than individuals who focus almost exclusively on running the operations of the company beneath them. On top of that, their pay is subject to intense scrutiny. And why would you want to list if you could go into the private equity world where you won't have those same disclosure requirements, where you can probably get paid more money, and I'll show you how managers make money later, and your pay won't be subject to the same scrutiny? What's the incentive? Why would you want to do it? So I think there's that factor at play as well. Now, we all tend to think of disclosure obligations as a good thing. And in a world that's focusing on sustainability, that is probably right. But what we don't think about is the knock-on consequences of those disclosure obligations. Now, will this trend continue? I don't know. I mean, if you looked at that chart I circulated, you'll see that private equity sort of develops in waves, and it's done that since it developed in the 1980s. And what you will see is that there is a downturn in fundraising and investment that coincides with an economic downturn, a recession. But each wave afterwards, as economies pull out of recession, peaks at a higher amount of money under management with bigger funds under management than the previous wave. Now, if that trend continues after the next bump in the road for private equity, then pretty much every listed company, other than the most ginormous, is going to be within reach of private equity fund managers. In the autumn, there was talk of Walgreen, which now owns Boots and is a US listed company, being taken private in a $70 billion payout. Now, there aren't very many FTSE 100 companies, probably 15, maybe 20, that have a market capitalization that's greater than $70 billion. There will be more in the US, but we're talking relatively small numbers. So if this trend continues, then it's going to eat further into the listed company stock. And there are questions about whether ginormous listed companies like Apple are a good thing. I mean, some commentators are now saying, well, what we're seeing is the development of corporate oligopolies that aren't probably properly subject to the competition that typically you would see with smaller companies. Now, what I've described is a very successful part of the corporate finance world. What you won't find in very many books on company law or corporate finance is much that's said on private equity. Actually, Louise and Jenny Payne have written an excellent chapter in their book that I commend to them, and I'm sure Alice will be picking one up in her new edition. I think it's something that should be better studied, not just in terms of returns, at the academic level. I'm giving you the practitioner perspective and putting it in context. And what I'm seeing, what the data shows, is how important private equity has become to the way corporates in the Western world in particular, and one suspects eventually elsewhere, are financed. I seem to have done something here, Louise. Sorry? I need to move on to the next slide.
Yes.
All right, okay. Thank you, John. You show how untechnical I am. So, looking into the nitty-gritty, and this is what we're going to turn to now. So, what is a private equity house? Most are relatively small organisations that are owned by the people that work for them. When we talk about a private equity fund, we're not talking about the private equity house. The house itself is the asset manager. It's owned by the people that run it. That wasn't the case in the UK to begin with. In the 1980s, when private equity houses really started emerging in this country in quantity, they were in the main subsidiaries of banks, insurance companies and other financial institutions. And what they were doing was investing the capital of those organisations in deals. But conflicts of interest and other issues meant that they spun them out, mainly in a 10-year period between about 1990, 1991 and 2000 and 2001. But CVC, a very prominent private equity house, was originally the European venture capital private equity arm of Citibank. Bridgepoint, a substantial UK-based but European and American private equity house, was originally the private equity arm of the NatWest Bank. Equistone was originally the private equity arm of Barclays Bank. It was called Barclays Private Equity, and so on. In the US, actually more or less from the start of the development of the buyout world, independent organisations of this sort were the norm. And they were encouraged by changes to the American pension regime in the late 1970s, the ERISA rules, allowing pension funds to invest in private equity houses and that sort of thing in a way that they couldn't before. But today, in this country, in Europe, around the world, most are private organisations that are owned by those who work for them. A few aren't, like 3i, that's a listed company, a component of the FTSE 100, and it invests its own money today. There aren't very many like that, but there are some. And the money they raise externally, and I'll come on to who the people are, goes into, and this is the fun bit, a limited partnership. Can you guess why a limited partnership is used as the common structure for private equity funds as opposed to the house? There are two principal reasons. Yes, tax is one. They are tax transparent, so there's no tax leakage at the entity, the fund level. So if a limited partnership makes an investment in an investee company, a gain is made, there is no tax levied at the limited partnership level. It's levied at the level of the ultimate investor. If it were a company, for example, there probably would be. What's the other reason? The clue is in the first word. Limited liability for the investors. Now, a limited partnership has a general partner and limited partners. A general partner will be a subsidiary of the house. It technically is the manager of the fund and has to make all the key decisions relating to it. And it has unlimited liability. But the way the funds work is that for each new fund, a new GP will be set up. But the real work is done by somebody that has a management or advisory agreement with the limited partnership. That'll be the regulated entity and another subsidiary of the house. And that's where most of those who work for the house will be employed. We're going to come on to this in a minute. Most funds have a limited life. They'll be illiquid, and there won't be borrowings at the fund level. And that does raise a question that I asked right at the start. So, is there any systemic risk issue that you could see flowing from private equity? Yep.
If institutional investors are allowed to invest in those private equity funds, there is a substantial systemic risk.
Why is that?
Because if pension funds are investing in private equity investments and this investment doesn't have an adequate return, then some schemes that are really important will fail.
Well, yes, but they don't put we'll come on to this as well. They don't put 100% of their assets in private equity. I mean, I think the answer is there is very little systemic risk associated with private equity, because each investment stands on its own, and while some investments fail, it doesn't have a knock-on effect into other investments. And that was something private equity pointed out when the European Commission proposed that the industry be regulated in the same way as the hedge fund industry should be regulated. And that regulation materialized as the AIFMD, the Alternative Investment Fund Managers Directive. The two were lumped together. With a hedge fund, there is a liquidity issue in that investors can ask for their money back whenever they want it. And there is often borrowing at the fund level. So there is a much greater potential for some form of systemic risk with hedge funds, but it's quite hard to pick it out in private equity. I mean, have a go. I'm certainly willing to debate it. So I've been talking about the investors in private equity, but who are we talking about? Well, what we're talking about is institutions. The biggest, and these bar charts are of Bridgepoint funds. We do a lot of work for Bridgepoint, and they provided us with this information. And this is not untypical. So the pension funds, particularly US pension funds, are the largest investor in private equity. Insurance companies, sovereign wealth funds, sometimes universities are big investors in private equity. Now, the biggest investor in the private equity industry is a Canadian pension fund, Canadian Pension Plan Investment Board, that has $79 billion out of, as of the end of last year, $360 billion that it has to look after invested in private equity. In the UK, there are far fewer big investors of the sort that you see in the US, but one of the two biggest is one that Louise and Eilish will have a keen interest in, which is the one that provides pensions to academic staff, that has 10.6 billion, this is as of March last year, invested in private equity out of assets that, from memory, are around about 70 billion, I think, something like that. I hope you're not all going on strike soon. Now, I'll circulate something else that shows you, which is partly answering your point. And this is taken from the Preqin report. It shows the number of investors in different geographies, the percentage of their total assets that are allocated to private equity, and the target that they would like to achieve for their assets to be invested in private equity. And you'll see that the country or the area with the highest number of investors is North America and the US in particular. The institutions there have the highest allocation to private equity and one of the highest targets. Actually, a country with even higher allocation and targets is Singapore. Anybody from Singapore? And I think that's partly because a big investor from Singapore, big investors, the two main sovereign wealth funds in Singapore, GIC and Temasek. And sovereign wealth funds often have an even higher allocation to private equity. Not all. The biggest sovereign wealth fund in the world is the Norwegian one, surprisingly, given the size of the country. and they've made a decision not to invest in private equity. They're very unusual. And I should add that the numbers of investors investing in private equity has been going up. That's been increasing, and that's partly accounted for the substantial growth in the assets under management of private equity houses. Yeah.
Did the Norwegian sovereign fund, do they have any reason for not investing particularly, or it's just...
They didn't really explain it in anything that I saw. There was a big move for them to invest in private equity last year, and they had a meeting of their equivalent of their trustees. I don't know how it's structured, and they decided against it, but I didn't see anything properly explaining that decision. So private equity has become increasingly popular, and the allocation percentages have been going up, which again partly accounts for the growth in the assets under management. Now, just having a look at the life cycle of a private equity fund. I said they were limited life, and the typical private equity fund has a 10-year life. So in the early years, after the fundraising has happened, and I should explain, when an investor commits to a private equity fund, say it commits £100 billion, it doesn't write a check on day one for £100 billion. What happens is the money is cooled down when it's needed to invest in an underlying investee company. So they'll have to keep in mind that their money will be cooled over time, but not all at once. And most of the investors are so large that that's not a problem, and they have quite sophisticated models to manage their cash flows. So most of the work, to begin with, after fundraising, will be actually sourcing and making deals. Yeah.
Just going back a little bit, so this increase in private equity and decrease in investment in public listed companies, what sort of effect do you think that has on inequality? Because obviously it's less likely that people are going to be able to invest, standard people are going to be able to invest in private equity.
That's true. There's been quite a lot of debate actually in the US about whether there should be more retail availability, i.e. to you and me, of private equity funds. But that's not to say that we don't have exposure to them. We do through the pension funds that provide our pension, the insurance companies that insure what we're doing, and some of the financial institutions that I'm talking about who are the big investors in private equity. But you're right that it's very difficult for you as an individual to invest in most private equity funds. Now, there are some, like 3i, that you can invest in because they themselves are public companies. And another trend in recent years, what has been for very large private equity houses to actually float their management company, the house itself, as opposed to a fund. So KKR, Blackstone, and recently EQT, the largest Scandinavian-based private equity house, have all floated their management companies. And you could invest in them and get an exposure as an individual investor to private equity that way. But you're right, it does, and wealthy individuals who have their money managed by people like Barclays Wealth and UBS Wealth do have access to private equity funds by virtue of the Barclays or UBS Wealth or Coots Wealth, whatever it is, network. So in the early years, they will be investing, and then in the middle years, this is all very simplistic, they will be working with the companies they've invested in to, one hopes, improve them. That's one of the three things that, one of the three levers that are used, or perhaps more, one of the main levers I was describing they use in order to achieve the success that they do. And then the later years of the fund will be exiting the investments, selling them. Now, the most common exit route is to strategic corporate buyers. The second most common route, and this in some years is the most common, is by selling to another private equity-backed company, so a so-called secondary buyout, if it's in the buyout world. There may be dividend recapitalizations along the way, so the company will have done well. Some debt might have been paid down. I'll talk a bit more about the way debt works. And they might recapitalize it, take on more debt, and use that to pay off the shareholders, give them a return on their investment. IPOs are very much the minority of the way private equity houses exit. Sorry.
It sounds like basically if you've got a private equity investor coming into a country, then it's into a company, then it's inevitable it's going to be sold, which to me seems to raise interesting tax questions, because often if you buy shares in a company, well certainly where I come from, if you buy shares in a company with the intention, a fixed intention of selling them at a specified point in the future, then you start to have issues with tax on sale. How have you seen that playing out in your practice?
Well, in the UK and indeed the US, there is certainly an intention to sell, but that doesn't itself trigger a differential tax treatment. And the sale of the shares will all be subject to capital gains tax. There's a particularly beneficial regime that has been in operation in this country called Entrepreneurs Relief that allows certain senior executives to benefit from an even lower rate of tax than the typical capital gains regime, which is lower in pretty well every country than the income tax route. And one area, well, I'll come on to the remuneration of private equity managers in a second, because that has had a very attractive tax treatment in most countries as well. So in my practice in the US, are you from Australia or?
New Zealand.
New Zealand, okay. I'm afraid I'm not familiar with the New Zealand tax regime, but in most countries, the sale of the shares will generate a capital gain at a much lower rate than would be the case either through the payment of a dividend or through ordinary income. So one of the attractions for investors is the tax will be low. And some of them will have no tax to pay because of the nature of the investing entity. And tax drives a lot of what we do in private equity. So what returns does private equity target? Well, in buyouts, it's a 20 to 25% IRR and a cash on cash, i.e. if you invest £1, what do you expect back by way of money? And here they expect a 2 to 3 times multiple of it. So invest £1, you expect 2 or 3 back. In venture capital and some buyouts where the risk is higher, the target returns will be higher. What they actually achieve over a whole fund will be probably a little bit lower than that, but many are in this sort of range. Now, we were talking about medium to long-term investors, and what private equity houses aim for when they invest in a company is to realize it within a 3 to 5 year period because of the 10-year life cycle of most funds. Now, whether you think that's medium or long-term depends on your perspective. In the public markets, I've been trying to get hold of reliable data on this to find out the average hold period for shareholdings in public companies. And the reports I've seen are quite variable. One says the average hold period in this era of high-frequency trading is 22 seconds. And another research paper says, no, it's 4 months. And others say, no, it's longer than that. But all the data I've seen on the average hold period for shares in public companies indicates that they're held for a much shorter duration than would be the case in the private equity world. Now, within the public company world, as I said, because public companies have hundreds or thousands of shareholders, some will hold for a very long time. My father's got shares in Shell that he inherited from his father. So we've held them as a family probably should get rid of them actually, as it's an oil company. But anyway, for 50 years. but then there are high frequency traders who are selling every few seconds.
Chris, can I just clarify something which might not be useful? Going back to perhaps the previous slide, I don't know, but because what you're talking about here is the whole of the shares in the portfolio company. The whole is.
Yes, that's right. That's the average, yes.
That's the average. But we talked about, as you say, you don't get, the investors in the fund won't get any money back until you get to the exit and returns. Is there
Sorry, no, they will get money back when an individual investee company is sold.
Yes,
Yeah.
but they won't get anything back till near the end of this period on the whole. And is there a secondary market in stakes in private equity funds?
Well, that's a good point. So I was talking about private equity being an illiquid
Yes.
investment. Well, one part of what is an increasingly mature world that isn't yet mature is exactly that. So there are funds being raised to take limited partnership interests off investors during the life of a 10-year fund. So they are providing a form of liquidity to the pension funds who are the limited partners, to the insurance companies that are the limited partners during the life of a fund. And that market is now relatively big. And I would expect that to develop more over the coming years. So to say private equity is illiquid is increasingly going to become misleading because of that factor.
During the exit option, is there any practice or advice to offer those shares in the company to the investors or to some of the investors in the fund in consideration for what they would get in cash back? Let's say they want to continue that.
Well, yes, sometimes. So when there is an exit, sometimes the existing private equity house will retain a minority stake. Sometimes, this has become a little bit more common, but is still rare, some of the investors in the fund themselves might take a direct stake. So I was involved not long ago in the buyout of a company called RAC, the Royal Automobile Club, it used to be. It's a roadside emergency service provider. It also actually provides a lot of insurance to car owners. And that was purchased from its then owner, Aviva insurance company, by Carlyle. Carlyle were actually at one stage thinking of IPOing it, but at the last minute, they decided not to do that. And they sold 50% of their stake to one of their big LPs, GIC, the largest Singaporean sovereign wealth fund. And that occasionally happens. And then they exited the other 50% last year or the year before to CVC. But GIC are still there as a 50% institutional shareholder in the RAC. And what you are seeing is a lot of institutional investors wanting to take co-investments alongside the private equity houses in the underlying investee companies. And that's become a big feature of the fundraising world. So GIC might say, well, we'll give you £100 million, but when you do a deal, we want the opportunity to invest not just through the fund, but directly alongside you through what's called a co-invest. And the attraction for people like GIC is that they avoid some of the fees that private equity houses charge that I'm about to come on to. So how are, I say, the fund managers remunerated? How is the house remunerated? Well, when buyouts developed, the typical model was a 2 and 21, and that has largely endured, notwithstanding the colossal increase in the size of funds. So the 2 refers to a management fee that is levied on the capital committed to each fund. And it used to be, when funds were much, much smaller, 2%. And the theory was that that fee would pay for the overheads of the house, the employment costs, the premises costs, and so on. When you've got a 25 $4 billion fund, a fee even of 1.5%, which would be more likely to be the fee on a fund of that scale, produces actually quite a big profit. And that is one of the reasons why the biggest houses like Carlyle and Blackstone and KKR and EQT have been able to float off their management company because they themselves are making profits. For most houses, it's probably true the management fee doesn't produce much of a profit. What the executives working for private equity houses really want is this bit, the carry. That's the 20% bit. And the way that works is that if a fund returns the original capital committed to underlying investors plus a hurdle return of 8%, everything that is then realised is then split between the executives or the house and the underlying investors as to 20% to the executives in the house and 80% to the underlying investors. And in a very successful fund, that can produce a lot of money for those working for private equity houses. Now, if you really want to make lots of money, if that's what drives you, don't become a lawyer. You can do very well. Join a successful private equity house because you will make a lot of money through the carry if that success continues after you join it. Now, there are strings attached to it I won't go into, but a lot of private equity executives are very wealthy. Stephen Schwartzman, who was the founder of Blackstone, has recently, for some unaccountable reason, decided to give Oxford University, I think, £150 million out of his own personal fortune. Why he chose Oxford, I don't know. Anyway, he didn't actually didn't even go to it. Leon Black, the founder of Apollo, and he's worth billions. All these founders, these senior executives, are exceptionally wealthy individuals. But even the more junior executives, once they reach a certain level of seniority, can make a lot of money. What they also do, actually it'll be through a vehicle that'll be set up for the purpose, is to co-invest in the investee companies alongside the funds that they manage. Investors like them to do that, so they've got so-called skin in the game. But that's another way that they themselves personally can make money, and often do. I talk current trends, but I've talked about co-investment and what that means and how that works. And the reason institutions like it is because they don't have the carry applied to the co-invest. They probably will have some form of management fee, but it might well be lower than the 2%. Now, it's quite remarkable how the industry, since its foundation, has more or less retained the same remuneration structure, notwithstanding the massive growth in funds. Now, the other feature that you were raising was tax. The carry is taxed in most countries. It's become a bit more complicated, but in essence, it's taxed as a capital gain, not as income. And people like me say, well, hang on a second, you're not risking much here, you're just doing your job. And you're being paid a lot of money if it's successful, and you're paying capital gains on it, not income tax. That has been the subject of repeated attack in different countries, but the industry has been able to fight off that attack. And there's no immediate sign that the tax of the carry is going to change, even though I think even most private equity executives would admit it's probably not fair. So, that's roughly how the fund works. Are there any questions on fund structure? So you've got the house, you've got the funds that it manages, and there will be a different structure for each fund, typically set up as a limited partnership. There are similar vehicles that aren't limited partnerships, but they're basically the same type of creature that are used in certain other jurisdictions where you see funds set up like Luxembourg. The investors in those funds, limited partners, are institutions in the main. The fees are actually quite rich by comparison with those levied by the Vanguards and BlackRocks, the big index tracker funds. But they provide alignment, in most cases, between the underlying investors and the deal executives. You could argue that where the management fee produces a big profit, that alignment is partly lost and could give rise to conflicts. So we clear about the way the funds themselves are structured and work. And as a lawyer, if you're thinking of going into private practice, firms like mine that have a big private equity practice also have a funds formation practice. And if you're a lawyer in private practice and you're doing private equity work, one thing you can do is, not the deal side that I'm about to come on to, it's the funds formation side. And you will be drafting the limited partnership agreement and all the other documents that are needed when a private equity fund is raised. I mean, the disciplines that are at play when a fund is raised from the legal perspective are the corporate drafters who do the drafting, tax lawyers, because tax drives structuring of the funds and the way they're set up, and regulatory lawyers, because each fund is today regulated, by virtue of the AIFMD. Now, how that'll unfold in the new bright world of Brexit, we're not quite sure. There's one issue has been whether those houses who have a UK licence only, who want to raise money from European institutions, will be able to do it under some form of passporting or equivalence regime in the future. And what houses have been doing, who do raise a lot of money from pension funds or other institutions in Europe, is getting a licence in another European country. Luxembourg is the most popular. And putting a few people on the ground, because it can't just be letterboxes, but what they want to do is to subcontract back to London, where they've got most of their people, most of what the fund does. And a big question mark we don't know the answer to is whether that approach is going to endure, or whether the European Commission will seek to change those arrangements so it's not possible to contract back to London in the way that they hope to do. We will see. That could have a substantial effect on London as a private equity portal, which I was talking about right at the start. Now, I'm going to talk about deals. I've got a handout actually that somewhere around there we go. It'll probably make it a little bit easier for you to see this. Now, in the venture and growth capital world, what happens is there isn't a structure like this. The private equity house invests directly in the target, and the money goes perhaps to provide a bit of an exit for a founder, but most of the money goes into the target to help it develop and grow, to take it to the next stage. And there won't be debt. This structure is a simple structure for a buyout. And as you'll see, there are lines all over the place, and I'll get on to what those lines mean in a minute. Now, if you're a deal lawyer, that's what I am, a deal lawyer, and you're on the buy side acting for a private equity house, you will be doing four things. You'll be negotiating the terms on which UK 3 acquires the target. You'll be negotiating the terms on which debt providers provide debt to the structure, and the money that is raised on both the equity and the debt side is used to buy the shares of the target, not to help it develop and grow. There may be extra lines of debt that are incurred to help it do that, or because it tends to be much mature, it may be able to do it out of its own cash flows. you will undertake some due diligence, and I'll come on to this, in relation to the target, that's legal due diligence. And there will be a series of contracts between the managers and the investor, a shareholders agreement or investment agreement, and you will negotiate them as well. So there are four things: the acquisition, the debt provision, the due diligence, and the equity documentation. I'll come back to this slide in a minute. Now, you might wonder why there's a stack of NewCos. That's because the debt providers have security, and they like to be closest to the target. And the equity holders, because they come in at a higher level, are structurally subordinated to the debt providers. They will be contractually subordinated as well, actually, by a creditor agreement. And the money that the investor provides is not actually, in the main, ordinary share capital. Most of the money a private equity fund invests goes in the form of a debt instrument, a loan note or a preference share with a fixed coupon on it. Now, this is how private equity works. So this bit is the debt. The bit above it is the loan note or preference share. And the bit at the top is the sliver of genuine equity, the ordinary shares. If you're a manager, you will acquire some of those ordinary shares. You won't be required to put in, if it's a primary buyout, any of the grey bit. And from a management perspective, a buyout, in simple terms, is a bit like buying a house in the UK with a 95 or 98% mortgage. Are you familiar with the way the UK housing market works? It's probably similar in other countries from which many of you come. So you buy a house for £100,000, you get a mortgage from Barclays Bank, £95,000. You've got £5,000 you put into buying it. You own it for 5 years, you pay down half of the debt, the housing market is growing like topsy, this is the multiple arbitrage bit, and the value of the house increases to £200,000. So what's left of the debt is half, so £47,500 plus a bit of interest, but the rest of the £200,000 goes to you as the person that only put up £5,000 to begin with. And that's the equivalent to the management fee of equity. And that's why management, senior management, can do extraordinarily well in private equity deals. I've worked with managers who've made hundreds of millions of pounds over the years in successful deals. So perhaps not be a private equity executive, perhaps be an executive of a really successful company that's backed by private equity. I'll come on to the way the debt works. Now, the institutional loan notes and preference shares actually won't have a coupon that is a current pay one. So you don't have to pay interest on the loan note or a dividend on the preference shares every 6 months or something. And that's rolled up, and that's only paid out at the end, which is why that grey bar was grown. Some of the debt this is showing is being paid down, rather as I described in relation to a house purchase, which is why it's shrunk in this diagram. When I started in M&A in the 1980s as a child prodigy, M&A was dealt with differently to the way it is dealt with today. The buy side was in control. The buy side, the buyer, drafted all the key documents. There was virtually no due diligence, and management teams weren't really big players on the scene. That has all changed in Europe in particular. The practice in the US is a bit different. Now, I edit and contribute to a book on private equity called Private Equity, practitioner's guide. It's a legal book, and we're about to go through the 4th edition, and there is a good chapter in it written by some partners at Latham and Watkins on the difference between the UK and the US practice in M&A. And if you are interested in looking at it, that chapter is worth a read. I will try and provide Louise with a copy of the book. And I know discounted copy, I'm sorry, I'm selling it as a plug, are available to students. Anyway, we'll make sure that if you're interested, you get hold of a copy. And some of the things that I've been talking about are examined in a little bit more detail in the 2 introductory chapters, which are the ones that I've written. Private equity, I think, was one of the main catalysts behind changing private equity techniques over the period in which I practiced. And because private equity appeared on the scene as essentially professional deal doers and competing with corporates for assets, the sell side came to control and dominate the whole process. And I'll explain in a second the way a deal works. Now, on a deal now, private equity are really, really good at doing deals, and they often buy companies in competition with corporate strategic buyers when they shouldn't be the winner. The strategic should often be the winner. But when a company is being sold and there's a competition, one, apart from the price, another vital ingredient in determining who wins is their ability to execute the deal fast. And that's what private equity is really good at, and a lot of corporates aren't. And they often lose out when they should win because they're too slow, they don't understand what's required of them. So private equity has helped and driven not just that process where the sell side dominates, which I'll describe in a bit more detail in a second, but the professionalisation of things like due diligence. Now, I said due diligence was hardly done at all. It wasn't in the 1980s. And a lot of companies that private equity backed, actually, I think, foundered because the executives didn't understand properly what they were investing in and hadn't investigated the underlying target. They don't do that now. On a typical buyout, there will now be hundreds of people involved. And that's just on the buy side. But lawyers are all over buyouts. There'll be lawyers for the private equity house, there'll be lawyers for management, there'll be lawyers for the debt providers, and there'll be lawyers for the sellers. But there'll be loads of others as well. So due diligence now is very, very sophisticated. There'll be financial due diligence, commercial due diligence, if it's relevant, insurance, property, environmental, there's even political risk due diligence sometimes commissioned. And private equity houses really do get under the skin of what it is they're buying. So how are companies sold today? Well, what happened in the 1990s was that companies came to be auctioned rather than bilateral relationships leading to a sale and a purchase. And an investment bank or other corporate finance advisor today is commissioned to approach those that the bank and the existing shareholders think might be interested in buying it. A limited amount of information is provided in an information memorandum, and they're asked, first of all, to sign a non-disclosure agreement. Then they're given this information memorandum and said, if you're interested, please write back to us saying how much you're willing to pay for the company. And we will take a select through to a second round of the auction. And if the auction is a successful one, something like 4, 5 or 6 will be taken through to that second round. And what they will be given is, first of all, access to a data room with lots of documents that provide a lot of detailed information about everything to do with the target company, from accounts to commercial agreements to the constitutional documents, to the pension scheme terms, the employment contracts and so on. they'll probably in Europe, the Americans don't do this for some strange reason, be given a set of due diligence reports commissioned by the sell side, vendor due diligence reports. I'm a big fan of those, but for two reasons. One, they speed up the process, because instead of buyers having to commission and do a full due diligence exercise themselves, which tends to happen more in the US, they're given most of the job on a plate. So what their due diligence providers are doing is just a top-up. And the other reason I like them is that if you're on the sell side and you're doing, for example, a legal due diligence report, you find out the problems in the underlying target company ahead of them emerging during the process itself. And you can then decide what to do about them. So you lift the stones and find the snakes underneath them, if there are any. But they're also given a sale and purchase agreement that is drafted by the seller's lawyers, in contrast to the way things worked in the bilateral world of the 1980s when the buyers did it. The sale and purchase agreement will contain details of the price to be paid, conditions between, to actually completing the deal, usually in this country in Europe, regulatory conditions, if there are any. It'll contain what's called a locked box rather than a set of completion accounts. That's the difference between the UK and the US. So the purchaser will buy the company, this is the locked box bit, as of a historic date, and the sellers will contract not to take any money out of the company from that date. So the buyers will be expected to due diligence the locked box accounts, and if the sellers have taken out money in breach of their covenant not to do so, there'll be provisions in the sale and purchase agreement stating that they have to recompense the buyer. Completion accounts are different. They require a set of accounts, as the term implies, to be drawn up as of completion, looking at things like the working capital of the business, the debt levels, the cash levels, all by reference to target amounts. And if they aren't met, there are then adjustments. Now, in the old days, they were common in Europe, but as part of the sell-side domination, we moved to the locked box structure, which is present on the vast majority of deals. Completion accounts, when I was acting for a private equity house on the buy side, were thought of as a way of getting back some of the purchase price. And that sometimes happened. I was dealing with one particular acquisition of a tool hire business where the lawyers on the other side got some of the accounting policies wrong. It was just a mistake, and we were able to take advantage of that and recovered, I think it was £25 million out of a purchase price of 200 million. So you had to be really, really careful. And they also involve protracted disputes often, which is why we don't really see them this side of the Atlantic. Now, the other thing, and this often takes up the bulk of the space in a sale and purchase agreement, is warranties. Now, do you know why warranties appear in sale and purchase agreements? They're there to allocate risk. Well, that was the original purpose. So there's no Sale of Goods Act in relation to buying and selling companies. And if the company you're buying doesn't have an engine, in the absence of a misrepresentation, it's caveat emptor, and you've paid the money and you can't get anything back, which is why warranties appeared. And the way warranties used to work was there would be tons of them extending over 60 pages, intricately drafted, heavily argued and negotiated, and subject to a cap of the purchase price. So they were genuinely risk-sharing tools. With the sell side dominating, what now happens is warranties are skimpy, the caps are low, it's never anywhere close to the purchase price, and it can be just £1. Now you might think that's a bit odd. And the reason is that what has developed in recent years is warranty and indemnity insurance. And we do a survey every year of all the private equity deals we're involved in, which is usually around 50 or maybe a bit more. And in the last few years, about half of deals have involved warranty and indemnity insurance. And the way that works is the sell side approaches a broker, gets an outline policy, says to the buying community, there's going to be a warranty and indemnity insurance policy. There's going to be a cap of £1 on the warranties, and you've got to turn to insurers if you want real risk sharing. So the insurance will key off the warranties that are agreed, and the cap on the insurance product will depend what the buyer wants. The pricing, sorry, let's go on.
No, I was just going to say in the UK, I assume the insurers expect to see a negotiated set of warranties, or are they,
Yes.
what's
Yeah, they do expect to see. They take a lot of comfort from the identity of the law firms involved in the transaction. They themselves will instruct some lawyers to look at the sale and purchase agreement, to look at the due diligence reports. These policies are now common in the US and in a number of European countries. The pricing and what the policies cover does vary a bit. So in the UK, the pricing is typically 1 to 1.5% of the sum insured. In the US, it'll probably be closer to double that. But US policies cover more risk than they do in the UK.
In terms of the structuring, is it normally structured so that it's a normal cap, say purchase price or whatever, but with no liability except under the W&I policy? Or is it normally structured so that there is, in all cases, like £1 liability?
The latter.
Right.
Now, you don't see them on every warranty and indemnity insurance backed deal, but that has become really quite common in the current environment. There's been a lot of capacity in the insurance market, which has driven down the price, meant that policies have fewer exclusions than they used to, and enabled this type of product to evolve. In the UK, if a private equity house is selling a business, incidentally, and this is true in most but not all European jurisdictions, the private equity house itself will never give warranties other than title ones, i.e. that it owns the shares. The warranty burden will be placed on the management, but their liability will be tiny, even if it's not £1. So that's part of the excitement of being a lawyer in the private equity world, negotiating the sale and purchase agreement, but not quite as exciting as it used to be because you've got less to argue about because of the dominance of the sell side. Now, the other element that's appeared on the scene is management. Management is now a very important part of the whole M&A process in a buyout. That's for a number of reasons. Management will have to cooperate with the sellers in producing vendor due diligence reports, and there will be management presentations in the second round of a bid in which the senior managers appear before the buying cohort to talk about the business and answer questions on it. And usually the buyers will want to back that management team and want to incentivize them, and will want to agree the basis of the incentivization arrangements with that team in advance of doing the deal, because if it leaves it until afterwards, it doesn't know whether that team's going to be around or not. So there are now particular advisors that have grown up to advise managers. So within our private equity team, we have a particular group that focuses on advising managers. There are specialists, there's 4 of them, financial advisors, whose business is to advise management on the financial aspects of a buyout and try to negotiate for them the best financial term that they can get, meaning the biggest amount of sweet equity. And all of this eventually will be encapsulated in documentation, an investment agreement that will set out what both the private equity house and the management are going to invest, how much money. It'll set out some more warranties, but these are even lighter touch. These warranties are typically around the business plan that everybody's going to work to after the deal has happened. So the management will say, as far as we're aware, we think this plan is achievable. We've set out in it all the key assumptions, and there's nothing we know of that's been omitted from it. And the cap on their liability there will be 1 or 2 times their salary. The other equity warranties will cover things like questionnaires. So each equity house will issue a questionnaire to the management team. The answer to most of the questions should be no. So the questions are things like, have you ever been convicted of an imprisonable offence? Have you ever been disciplined by a professional body? That sort of thing. I can tell you some stories about late appearance of management questionnaires, but I'll save that for the drinks. It'll set out the governance architecture, who's going to go on the board, what regular information will be provided by the company to the private equity house to enable it to monitor what's going on in the business. So monthly management accounts, updates of business plans, annual accounts, 6 monthly accounts, chief executive reports, all that type of stuff. It'll set out a list of big decisions that can only be taken with the express consent of the private equity house. Bear in mind, the house itself is not running the business. The managers are their backing. And it'll legislate for the exit. So it'll say in European deal, most European deals, if there are warranties to be given, you, the management, will give them, and you agree that up front. That's the price of you getting sweet equity. It'll also legislate what happens on an IPO, actually, even though they're much rarer than sales. Private equity houses also like sales because they get out as to 100%, whereas in an IPO, it's very rare for them to be able to do that. They can only sell a percentage of their stake, and they're subject to the vagaries of the market for selling the balance. And in an English deal, there'll be the constitutional documents of the top company in the UK stack that will have articles of association setting out some key provisions governing the relationship between the management team and the private equity house. So it'll set out the rights attaching to the shares. So if there are preference shares, it'll set out what they are. If there will be ordinary shares, but management will usually have a different class with slightly different rights, not economic ones, but other rights to the private equity house. There might be different economic rights because managers may have something called a ratchet that gives them, rather like the carry, a higher percentage of a very successful deal's ordinary share capital proceeds. It'll importantly govern what happens when an executive leaves the newco group before the private equity house exits, so-called leaver provisions. And the way they work is the manager can be forced to sell a share, and the price he gets or she gets for them will depend on the circumstances of their leaving. If they're ill or maybe retire or die, they will get a good price. If they voluntarily resign or are sacked because they got their hand in the till, then they'll get a bad price. And they'll also say that the private equity house can force the managers to sell, even if they don't want to. But the manager will say, well, yeah, that's okay, but we don't want you to sell without us being able to sell as well. So there'll be a drag-along provision. So those are the documents that are negotiated between the management's lawyers and the private equity house's lawyers. There will be other documents, but they're the most important ones. So management's lawyers are interested in things, the sort of Allen and gold reefs and all that type of stuff. And the final bit is the debt documentation. Now, Louise has told you all about that. In the old world, before the financial crisis, most of the money was put up by banks. And the way the banks put up its money was usually structured into 3 tranches, A, B, and C. A was amortizing over the life of the debt facility. So you've got to pay a certain amount of it back every few months or every year. And you'd have to pay interest all the time. Then there were B and C facilities that were only repaid on an exit, although interest would probably be paid on a current basis. There might be a mezzanine provider who provided another tier of debt. The senior debt would be secured. The mezzanine debt probably would be, but it would be second ranking behind the senior debt. The mezzanine providers would expect a higher return because it's riskier money. and they might have an equity kicker, an option over some of the ordinary shares, typically 3 to 5%. The way the senior element in particular used to work, and now does work again, is that somebody would underwrite the debt and would then syndicate it after the deal had happened. And quite often the underwriter was left with nothing. So there was a bit of a conflict there because the person negotiating the debt terms didn't have to live with them. And that was a bit of an issue in the financial crisis when it first hit. Because what happened with some deals, Boots was a good example actually, was that the deal completed just as the debt part of the financial crisis hit in 2007 when financial markets completely froze and they weren't, the underwriting bank wasn't able to syndicate any of its debt. And that happened in a number of deals and caused a major problem in the debt markets for a period after the financial crisis hit. And because there was so much debt floating around looking for a home before the financial crisis, the terms on which debt was lent became more and more favourable to the borrower. Covenant-light deals, as they were so called, with virtually no covenants. A senior facilities agreement typically has, it says when money can be drawn down on it, when it has to be repaid, the interest, and it contains a load of covenants which, if breached, enable the debt provider to enforce its security. Well, all of those disappeared, some of the key ones, meaning that debt providers are, at the time of the financial crisis, were sometimes not able to do anything, even though the company wasn't doing very well. What we see today is the documentation in similar form, but the people providing the debt have changed dramatically. Half the debt now is not provided by banks, it's provided by alternative debt providers, quite a lot of whom are themselves private equity houses. So private equity houses, as part of what they're doing, are now raising debt funds to invest in other people's deals. But it's not just them, there are others as well. And because there's so much debt floating around, we return to covenant-light days. Now, whether that's good, bad, we will find out in the next year or two. We might find out rather sooner than that, actually, because the coronavirus epidemic, not yet declared a pandemic, could cause major problems for private equity-backed businesses. We will see. And today, a lot of debt is provided on a unitranche basis. You don't have a senior debt and a mezzanine separate facility. You have one facility that is a combination of the two, the key ingredient being that it's only repayable on an exit. There's no amortizing part of the debt. And that's the typical model that alternative debt providers use. There are other types of debt available, especially on the biggest deal. So the debt capital markets, the listed, the publicly traded part of the debt world, often provides debt to the very largest deals. But the deal has to be of a certain size to justify that, the high yield market. And the high yield market has an unpleasant habit of closing and opening at very short notice. Now, we're nearly at an end. So, final thoughts. Private equity houses are here to stay as a central part of corporate finance, in my view. They've become vital providers of money to lots and lots of companies in countries like the US, the UK, and other parts of Western Europe. I suspect they will eventually populate more Asia. One thing I alluded to earlier, there's been a bit of a flight to quality. What I mean by that is that lots and lots of money has gone into private equity raised funds, but more and more of it has gone to the most successful and the biggest fund managers. There's been a particular trend in the last year or two, and a much higher proportion of the overall amount of money is now going to them, people like CVC, KKR, Blackstone, and so on. So it's harder to set up a new private equity fund than it used to be. Because of the success of private equity, it's not just new investors in funds that have been appearing on the scene, but some have been investing in direct deals in competition with private equity houses. So some of the people who used to invest in other people's private equity funds are now investing directly. Canadian pension schemes are particularly good at doing that. So OMA's, the Ontario Municipal Employment Retirement Scheme, does that. The biggest one of all, CPPIB, the Canadian Pension Plan Investment Board, has begun to do that. Teachers, the Ontario Teacher Scheme does that. They've got vast sums of money. They invest big checks. And there are others who are doing that. They do it because they want to avoid the fees. They think they can make more money if they do it themselves. Family offices are increasingly following private equity strategies. And sovereign wealth funds are now themselves investing directly as well. So the market is becoming more diffuse. Private equity houses themselves are sometimes now raising long hold funds that don't have the 10-year life that I talked about. There's a handful now that have got 15 or 20-year funds. And they are following not just credit strategies. Private equity houses are now becoming multi-product asset managers with funds focused on not just what I'm calling private equity, venture, growth, buyouts, but also real estate and infrastructure. And we've talked about the rise of the secondary market before. Now, private equity has challenges. What is going to happen when the next downturn arises? Will there be another growth and a peak that exceeds the current one? That is an open question. And what will the knock-on effects be, therefore, on the public market world? Private equity is subject to more and more regulation. The world is becoming more protectionist. I mean, Brexit is, above all, a protectionist move. No country has ever negotiated deliberately to increase barriers before in the way that the UK is now doing. But it's not just that. You've seen in the US the growth of something called CFIUS, the Committee for Foreign Investment in the United States, which now has a very broad remit to block takeovers of US companies on so-called security grounds. What is security in the US seems to be almost anything. And that is causing problems for private equity buyers. Other countries are now introducing legislation of that sort. The UK has a narrow regime that's broadened a bit, but is going to broaden further. And you're seeing other countries doing the same. So that sort of protectionist approach is a bit of a stone in the wheel of the M&A machine for private equity houses. What effect that will have, I don't know. And private equity houses are themselves going to be required to disclose more, although I don't think they're ever going to be in the position that I describe public companies as being in and having the handicap that I say public companies have. Does produce benefits, of course. Gosh, just as well I went close to a drink. So challenges for the private equity world, but for the last 20 years, an unbelievably successful world. And one that I've thoroughly enjoyed practicing in. So that's all from me. We're at 6 o'clock now. I don't know whether you want questions now, maybe a bit late.